We've just had a decent set of data coming out of China, the latest in series this week. The GDP print 6.7%, bang on, better than concerns that we'd start to see a fall off that comes on the back of what was a better car sales figure as well. Export numbers out of China. Is something turning in the sentiment story from the mainland that could be positive for equities?
Well, I think it is, and it's reflecting actually an improvement in the momentum of the global cyclical data. The manufacturing data that we've seen globally is bottoming out, and I think that's helpful for markets, and it comes after quite a long period of contraction. Obviously, the China data is also responding in some part to easing that we've seen over the last few months, and to some degree also the pressure that's come off as a result of the dollar weakening, as US interest rate expectations have been pushed out. So I think all of those at the margin are positives.
What happens on the S&P 500 from here? Because investors have rightly so taken a look at the high levels we've got now on the index, and they're looking for catalysts to move it north. The earnings are still providing a mixed set of data. The China story, no one truly believes we're seeing full stability at this point or growth from that level. And the US economy, well, we've had such mixed messages from the Fed. It's hard to, make a trade on the back of that story. So what's the rationale for stocks to trade higher from here?
I don't think there is a great rationale. I think the index in the US, and that's true for most equity markets, is probably stuck, and we describe it as a fat and flat range, a wide, volatile trading range with relatively flat returns. And I think although there are some signs that economic conditions are improving a bit, you've got a pretty high starting valuation in around the 90th odd percentile relative to history in the case of the US. And earnings, as you say, are pretty slow. So the combination really, I think, limits the extent to which you can see the index really breaking out. But I would expect to see continued volatility and rotation beneath the surface of the index, and that's where a lot of the action, I think, will take place.
What about a window of opportunity for a trading rally here? Because there, as you point out, I mean, there's some better-looking numbers coming out of China at the moment. Just take the number at face value. But we had a great-looking jobless claims number out of the United States yesterday, which again I think was the lowest figure since 1973, which encourages you to believe the Beige Book data, which says that the labour market is starting to exhibit some signs of tightening. All of that would suggest that the action that central banks have taken are starting finally to have an impact on economic activity. That seems to be the story that's helping lift equities at the moment.
Well, to your point,
you're
it's
sort of pessimistic about the longer-term upside here, but what about the trading opportunity as these data points
Well,
improve?
I think we've already seen a strong trading rally from the lows, and in large part, I think this reflects the extent to which you're seeing an inflection in the data at the moment. Yeah. I completely agree on the labour market, and we've been pointing out for some time that it's stronger than people have really taken on board. But you have to balance that also against, I think, the expectations of interest rates, which are still incredibly modest relative to our own view that as the US reaches full employment, core inflation is running at around 2.25%, service price inflation higher than that, the market price for interest rate expectations is too low, and they will be revised up, and that will prevent markets from rising a lot too.